What if you woke up tomorrow and your bank suddenly questioned how you use your own money? Shockingly, over 70% of banking rule changes globally are approved without public debate. And in February 2026, New Zealand just did exactly that. Overnight, a new banking rule was approved, and it could affect your savings, transfers, and daily spending as early as this week. Imagine trying to send money, pay a bill, or withdraw cash, and suddenly the transaction is delayed, flagged, or frozen. No warning, no explanation. Sounds extreme? It's already happening to thousands of customers worldwide under similar rules. Banks say it's about security and fraud prevention, but critics warn it gives banks more control over your money than ever before. So what changed? Who is most at risk? And how can you protect yourself before it's too late? Stay with us, because the last rule might shock you the most.
Number 10. Enhanced transaction monitoring. Even small transfers can trigger alerts. One of the most controversial February 2026 banking rules in New Zealand is the expansion of enhanced transaction monitoring. Previously, banks mainly flagged large or unusual transfers, but under this new rule, even smaller, everyday transactions can now be monitored, delayed, or temporarily frozen. That means sending money to family, paying freelancers, or moving funds between your own accounts could suddenly raise a red flag. Banks argue this rule is designed to fight financial crime, scams, and money laundering, and studies show that criminals often split large amounts into smaller transfers to avoid detection. But here's the problem. Regular customers now fall into the same net. If your spending pattern changes, your income fluctuates, or you suddenly make multiple transfers in a short time, the system may automatically flag your account. Imagine this scenario. It's late evening, you urgently transfer money for rent or medical expenses, and the transaction gets paused for review. You're left waiting, stressed and unsure when the funds will be released. This isn't a rare case. Banking analysts warn that automated systems don't understand personal emergencies, only patterns and algorithms. What can you do? Keep transaction descriptions clear, avoid unnecessary multiple transfers, and notify your bank in advance if you expect unusual activity. Reviewing your bank alerts and keeping your contact details updated is now more important than ever. If this worries you, don't forget to like the video, subscribe for upcoming rule breakdowns, and comment below. Have you ever had a transaction delayed or questioned by your bank?
Number 9. Stricter source of funds verification, proving where your money comes from. Another major February 2026 New Zealand banking rule focuses on stricter source of funds verification, and this one is already making many customers nervous. Under this rule, banks can now demand clearer proof of where your money comes from, even for amounts that were previously considered routine. Salary, freelance income, overseas remittances, gifts from family, or even cash savings deposited at once may now trigger follow-up questions. Banks justify this move by pointing to global research showing that illicit funds often enter the system through everyday accounts, not just high-value ones. By tightening checks, regulators believe they can reduce fraud, tax evasion, and organized crime. But for ordinary people, this means extra paperwork, delays, and stress. If you can't immediately provide documents, banks are allowed to temporarily restrict access to the funds while they investigate. Picture this. You receive a large amount from a relative overseas for a wedding, medical expense, or business setup. Suddenly, your bank asks for proof, transfer records, contracts, or explanations before releasing the money. Until that happens, your funds may remain locked, even though they're completely legitimate. To avoid trouble, customers should keep digital records of income, invoices, tax documents, and remittance slips. Planning large deposits in advance and informing your bank beforehand can also reduce the risk of account disruption. This rule changes one simple reality. Your money is no longer just yours unless you can explain it clearly.
Number 8. faster account freezes for suspicious activity. Access can be cut instantly. Under the February 2026 New Zealand banking update, banks now have the authority to freeze accounts much faster than before if an activity is labeled suspicious. What's alarming is that this decision can be made automatically without a human reviewing your case first. Even a small anomaly, logging in from a new device, sudden spending changes, or multiple failed payments, can trigger an instant restriction. The reasoning behind this rule is rooted in studies showing that fraud-related losses often occur within minutes, not days. By acting quickly, banks claim they can protect customers from scams and unauthorized access. However, this speed comes at a cost. False positives are increasing globally, meaning innocent customers are sometimes caught in the system with no immediate way to fix it. Imagine waking up and finding your card declined, online banking locked, and customer support overwhelmed. Your rent, groceries, or urgent payments are suddenly out of reach. While banks promise reviews within a reasonable time, that can still mean hours or days without access to your own funds. For people living paycheck to paycheck, this can be devastating. To reduce risk, it's now crucial to update your contact details, enable real-time alerts, and notify your bank before traveling or making unusual purchases. Keeping a small emergency fund in a separate account can also provide a safety buffer. This rule makes one thing clear: speed protects banks, but preparedness protects you.
Number 7. Tighter limits on cash withdrawals. Physical money becomes harder to access. Another quiet but powerful February 2026 banking rule is the introduction of tighter cash withdrawal limits across New Zealand. While digital payments continue to rise, banks are now placing stricter daily and weekly limits on how much cash customers can withdraw, even from their own accounts. The official explanation is to reduce fraud, robbery risks, and illegal cash usage, but critics argue it also nudges society further toward a cash-light future. Research shows that large cash withdrawals are often linked to scams, with victims pressured to take out money quickly. By limiting access, banks believe they can interrupt these crimes. However, this rule doesn't just affect criminals. It affects small business owners, elderly customers, rural communities, and anyone who still relies on cash for daily life. Weddings, construction work, emergency repairs, or cultural events often depend on cash payments, and these may now require special approval. Imagine planning an important family event and discovering you can't withdraw the cash you need without notifying the bank days in advance. In some cases, customers may even be asked to explain why they want their own money in cash. That shift feels uncomfortable for many, especially those used to financial privacy. To adapt, customers should plan cash needs early, explore alternative payment methods, and speak with their bank ahead of major expenses. This rule sends a clear signal: cash is no longer king, and access to it now comes with conditions.
Number 6. Mandatory biometric and digital ID checks. Your face becomes the key. One of the most futuristic and controversial February 2026 New Zealand banking rules is the expansion of mandatory biometric and digital ID verification. Banks are now allowed, and in some cases required, to use facial recognition, voice verification, or enhanced digital ID systems to confirm your identity. This goes far beyond passwords or PINs. In simple terms, your face, voice, or fingerprint may become the main key to your money. Supporters point to research showing that biometric verification can reduce identity fraud by over 40%, especially as scams grow more sophisticated. Stolen passwords and hacked emails are common, but biometric data is harder to fake. However, critics warn that once biometric data is compromised, you can't change your face the way you change a password. That raises serious concerns about data storage, breaches, and long-term privacy. Picture trying to access your account and being locked out because a camera can't clearly recognize you. Poor lighting, a new hairstyle, aging, or technical errors can all cause problems. For elderly users or those uncomfortable with technology, this can feel intimidating and exclusionary. To prepare, customers should ensure their digital ID records are accurate, keep backup verification options enabled, and ask their bank how biometric data is stored and protected. This rule makes one thing clear: banking security is becoming personal, literally built into who you are.
Number 5. Delays on international transfers. Overseas money moves slower. Another important February 2026 New Zealand banking change directly affects anyone who sends or receives money from overseas. Under this rule, international transfers are now subject to longer verification periods, even when the sender and receiver have a clean history. Banks say this is necessary due to rising cross-border fraud, crypto-related laundering, and scam networks operating across countries. Studies show that a large percentage of financial scams involve international payment routes, making them harder to trace once the money leaves the country. By slowing the process, regulators believe banks can detect suspicious activity before funds disappear. However, for ordinary people, this means longer wait times, missed deadlines, and added uncertainty. Imagine receiving money from family abroad for tuition, medical treatment, or business expenses, only to find out the transfer is under review. What once took hours may now take several days, especially if the bank asks for extra documentation or explanations. Small businesses that rely on fast overseas payments may face cash flow pressure, while individuals may struggle with time-sensitive needs. To reduce disruption, customers should plan international transfers earlier, keep clear records of the sender and purpose, and avoid last-minute requests. Using consistent transfer channels and trusted remittance services can also help reduce flags. This rule changes expectations around speed, making it clear that global money movement is no longer instant. Patience is now part of the process.
4. Spending behavior analysis. Your daily habits are being watched. One of the most unsettling February 2026 New Zealand banking rules is the expansion of spending behavior analysis. Banks are now permitted to use advanced algorithms to closely study how, when, and where you spend your money. This isn't just about spotting fraud anymore. It's about identifying patterns, changes, and unusual behavior in everyday life. Even perfectly legal purchases can now raise internal alerts if they don't match your normal habits. Financial research shows that sudden changes in spending patterns often occur before fraud is detected. Based on this, banks believe monitoring behavior can prevent losses early. However, the downside is that human context is missing. A life event like a new job, illness, travel, or family emergency can completely change spending habits, and the system doesn't always understand that. Imagine normally spending on groceries and fuel, then suddenly making multiple online purchases or booking urgent travel. That shift alone could trigger a review, payment delay, or even temporary card suspension. Customers are often left confused, wondering why their normal life choices are being questioned. To protect yourself, it's now smart to keep transaction alerts on, avoid rapid-fire purchases in unfamiliar places, and inform your bank when major lifestyle changes occur. This rule highlights a new reality. Your financial behavior is becoming a profile, and that profile decides how freely you can spend.
3. Automatic limits on high-risk merchants. Some payments may be blocked. Under the February 2026 New Zealand banking update, banks can now apply automatic spending limits or outright blocks on high-risk merchants. These include categories such as cryptocurrency platforms, online investment schemes, overseas gambling sites, and certain digital marketplaces. Even if these services are legal, banks are allowed to intervene before your payment goes through. The justification comes from data showing that a large share of scams and chargebacks originate from the same merchant categories. By restricting payments at the source, banks claim they can protect customers from financial harm. But the definition of high risk is broad and sometimes decided by algorithms rather than customer choice. Picture trying to invest in a new online platform, donate to an overseas cause, or subscribe to a foreign service only to see your payment declined with a vague warning. You may need to call the bank, answer questions, or sign extra confirmations just to proceed. For experienced users, this can feel like unnecessary control.
For others, it can be confusing and frustrating. To adapt, customers should check bank notifications carefully, use trusted platforms, and be prepared for extra verification when dealing with flagged merchants. This rule signals a shift where banks are no longer just processing payments. They are judging risk on your behalf before you can decide.
2. Joint account responsibility changes. One user can affect everyone. Another critical February 2026 New Zealand banking rule focuses on joint accounts, fundamentally changing how shared accounts are managed. Under this update, banks can now hold all account holders responsible for any unusual activity or breaches, even if only one person triggers the issue. This means that one individual's spending, transfers, or flagged behavior could affect every co-owner of the account. Banks justify this rule by pointing to cases where joint accounts were exploited for fraud or money laundering. Research indicates that joint accounts, while convenient for families or partners, can create shared financial risk. A single mistake, such as a large unexpected transfer, rapid spending changes, or transactions with flagged merchants, could trigger account reviews, freezes, or enhanced monitoring, impacting everyone linked to the account. Imagine sharing an account with a spouse, family member, or business partner. One late-night online purchase, a new subscription, or an international transfer could suddenly result in delayed access, temporary freezes, or verification requests. This is particularly important for households that rely on shared funds for bills, groceries, or emergency expenses. To stay safe, joint account holders should communicate clearly, track spending, and notify the bank in advance if a large or unusual transaction is expected. Some banks may offer individual limits or alerts within shared accounts to reduce risk. This rule highlights a new reality. In 2026, joint accounts are no longer just a convenience, they are a shared responsibility, and one person's financial habits can directly affect the entire household. Being proactive and informed is now essential to avoid surprises.
Emergency powers for banks. Immediate action without notice. The most striking February 2026 New Zealand banking rule gives banks emergency powers to act without prior notice, and it could affect anyone with an account. Under this rule, banks can temporarily restrict access, freeze accounts, or block transactions if they suspect fraud, money laundering, or other financial irregularities. Unlike previous policies, these actions can occur instantly and automatically without the need to notify the account holder beforehand. Banks argue that these powers are necessary to prevent large-scale losses or criminal activity, citing studies that show delays in intervention can result in millions lost within hours. While the intention is protective, the immediate consequence for customers can be sudden inability to access their own funds. For businesses, families, or individuals relying on daily transactions, this could mean missed payments, delayed salaries, or blocked emergency expenses. Consider receiving your monthly salary only to find your account restricted because the bank's system flagged an unusual deposit or transfer. You may need to provide proof, answer questions, or wait hours or even days to regain full access. While banks promise rapid review processes, the disruption can still cause significant stress and inconvenience. To prepare, customers should keep up-to-date contact information, monitor account activity, and maintain a small backup fund in an alternate account or payment method. This rule underscores a critical shift. In 2026, banks have more immediate control over your money than ever before, and staying informed and proactive is the best way to protect yourself from sudden account restrictions. The February 2026 banking updates in New Zealand are unlike anything seen before. From emergency powers and joint account changes to biometric verification, spending analysis, and tighter cash controls, these rules could impact how you access, transfer, and manage your own money. Staying informed isn't optional. It's essential to avoid delays, freezes, or unexpected restrictions. If this video helped you understand these changes, hit the like button, subscribe for more urgent financial updates, and comment below. Which rule worries you the most, and how will you adjust your banking habits to stay safe this week?